Hello, I'm Shaun Richard of Notayesmaneconomics. What I want to talk about today is a couple of issues that have popped up recently that are against what people are thinking about the economic situation. I think we've found ourselves in a situation where everything's downbeat. Some people are talking of a recession, but certainly a slowing in the world economy has been seen. If we say look at the euro area, gone from 0.4% growth in the first quarter, 0.2% in the second, worries about the third. If we narrow in our focus to the biggest economy there, Germany, this week there have been a couple of bits of bad news. The first was the confirmation in the GDP numbers that it did contract, the economy, in the second quarter. Not by much, 0.1%, but nonetheless a contraction. The second was the IFO report. I'm not a big believer in the exact detail of it, but it was downbeat again, and so that set expectations lower. So, Germany, for example, on that reading, could easily be in recession right now. We won't know for a bit because we won't get the numbers for this quarter until end of October, early November. However, this morning brought something up completely the opposite direction. I'm a believer in looking at the money supply, and particularly the narrow money supply, as an indicator of what's coming down the line for economic activity. So 6 months ahead, 9 months ahead, towards a year ahead. The good news is that twofold actually. It's worked really well over the past couple of years. Secondly, and this is something that's required for a useful signal, a lot of people ignore it still. What that's been telling us so far this year is that narrow money in the euro area, growth rate's been picking up. Started at 6.2% in January, it's 7.8% now. Not necessarily something you'd expect because they ended the QE expansion, which was pushing money supply higher in December. So in that respect, it's slightly odd. But in some respects also, that's better because it's an indication of economic activity to come, I think. So that goes completely against what we're seeing around the world right now. And we have a sort of, if you like, economy of two halves, I think. Underlying things, the euro area, I'm not saying it would be doing brilliantly, but bumbling on, a little bit of growth, maybe like what we saw in the first quarter, 0.4%. This, though, is on the other half, being squeezed by the trade war, particularly Germany, but other areas. Exports, manufactured exports, car exports are being squeezed. Should that end, we could see quite a bounce back. That would pose a problem for the European Central Bank because we think it's going to ease policy in September, so it will go further, or deeper if you prefer, into negative interest rates and restart QE. It could be doing that into a pickup. So there are various lessons here. One of the things is not to assume a set of circumstances and take a look at the data, I think, because narrow money's work really rather well as an indicator, as I've said. And this would be completely the opposite of what we're seeing. And if we look round at financial markets, so many of them are not pricing anything remotely like this in. For example, Germany's 10-year bond yield has dipped down towards minus 0.7%. It's in the high minus 0.6s today. That's not pricing any sort of return to growth later in the year or maybe next year. If we see this round stock markets, well, maybe they are a little bit. I'm not sure that the currency in terms of the euro is pricing that either. So as you can see, there's a whole swathe of things here that could change. And what we're really saying is, or what I'm saying, excuse me, is that one should look very carefully at the data like this when it gives a signal. Because in terms of markets, if it proves to be true, there's quite a lot of opportunities there because they won't be where they are. And also, as we come to the end of summer, it's nice for once to have some good news, isn't it? Thank you.